Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing.
Okay, so today's briefing is going to systematically deconstruct a massive structural transition playing out across the African digital economy. We are talking about the major shift from high-churn consumer apps to predictable, rock-solid corporate earnings. We'll hit this in 4 quick parts. First, the VC paradox of 2026. Then, the mechanics of asymmetric information. Third, the climate tech supply chain edge. And finally, we'll wrap with the repeatable flywheel framework that elite operators are using right now.
Right, let's dive straight in. Act 1, the VC paradox of 2026.
So here's the reality. For the past decade or so, the absolute consensus was just to subsidize consumer growth. But look, high inflation and massive currency devaluations have completely shattered that playbook. You've got the B2C subsidized customer acquisition cost model on one side. It's pretty simple. When you subsidize transactions just to acquire a retail user, well, that user is going to abandon your platform the literal second macroeconomic conditions tighten. It's a highly vulnerable model. But on the flip side, we have the alternative, the B2B embedded rail model. Instead of fighting tooth and nail for stretched consumer wallets, these enterprise networks are quietly digitizing foundational informal trade channels. They're building sticky infrastructure that businesses simply cannot turn off no matter the economic weather.
And the real-world outcome of that structural pivot? It's 120%. That right there is the baseline net revenue retention, or NRR, that these highly specialized B2B networks are consistently clearing. Actually, they're often averaging up to 130%. Think about that. While retail-focused platforms are out there battling purchasing power volatility, these B2B embedded platforms have made themselves absolutely central to their clients' operational continuity. So if you are allocating assets for defensive growth right now, this is the exact mathematical metric you really must index against.
Which brings us to Act 2, asymmetric information and talent verification. Let's look under the hood at the actual data mechanics here.
So, how exactly are these high-trust B2B ecosystems safely deploying working capital? Well, the answer lies in a paradigm we define as embedded everything. This is the seamless integration of operational infrastructure, financial capacity, and real-time data tracking, all baked directly into supply chain software. When an informal wholesaler uses a digital network just to manage their inventory sourcing, the platform unlocks deeply asymmetric information about their actual day-to-day cash flow.
And the really crucial point to grasp here is the sheer scale of the addressable market this tech unlocks. A staggering 80% of retail sales across sub-Saharan Africa still happen within informal retail channels, just 20% in the formal sector. So we are talking about massive, highly fragmented trade channels that have historically been plagued by a complete lack of working capital and just opaque inventory visibility. Digitizing this informal supply chain? That is exactly where the true alpha is concentrated right now.
Right? And this builds into a highly scalable financial engine through a very strict 3-step progression. First up, software usage. The merchant simply uses the platform for their daily inventory sourcing. Then, step 2 is data visibility. That consistent usage creates a clean, verifiable cash flow profile. And finally, step 3 is safe credit deployment. With granular, real-time visibility, the platform can safely embed credit facilities and trade financing directly into the transaction workflow itself. The operator isn't just offering a logistics service anymore, they've become a high-margin data trust.
And look, the proof of this operational superiority is already highly visible. We call this the Nigeria signal. A really remarkable 76% of fintech startups in that specific market are currently profitable, heavily leveraging these exact embedded revenue models. When finance is deployed directly at the point of need, say inside a B2B logistics or procurement app, it converts and retains enterprise clients at rates that standalone consumer apps simply cannot replicate. No contest.
Moving on to Act 3, the climate tech supply chain edge. Here, we're shifting gears from digital finance mechanics into real-world, cross-border physical infrastructure.
To properly contextualize this shift, we need to analyze what is basically a $240 billion mobile economy. Markets like Nigeria, sitting at an estimated $9.4 billion, and South Africa at $7.7 billion, are really leading the charge here. This growth is being driven by mobile-first infrastructure, rapid open banking approvals, and foundational integrations like M-Pesa over in Kenya. These B2B networks aren't operating in a vacuum. They're integrating directly with regional logistics, energy, and agricultural supply chains to capture this exact value pool.
Exactly.
And that deep integration fundamentally transforms the unit economics, which we call the yield. Predictable, monthly, recurring revenue from just a handful of enterprise clients managing commercial fleets or green energy infrastructure will massively outpace a B2C digital wallet that's struggling to monetize hundreds of thousands of retail users. By indexing their long-term contracts to hard currencies, structured commodities, or cross-border trade flows, these operators are shielding corporate revenue from local fiat appreciation. They effectively become a highly defensible credit engine.
Which brings us nicely to our final act. Act 4, the repeatable flywheel framework.
So before mainstream venture capital even catches on, elite operators are out there executing a very precise operational playbook. First up, sovereign infrastructure integration. You literally link directly into national switch architectures, localized central bank systems, and state-backed transport linkages. Second is API-driven agnostic delivery. Basically, your digital distribution rails must be highly modular, so existing corporate enterprises can just plug right in. Third is a strict, almost obsessive focus on contribution margin. And finally, Phase 4, institutional co-investment scaling. This kind of structural alignment is what turns theoretical potential into a highly predictable growth engine.
And global architectures really illustrate the absolute necessity of building these trust networks. To scale effectively across borders in Africa, you really have to sync compliance, legal structuring, and corporate risk underwriting. Leveraging cross-border diaspora business networks and aligning directly with sovereign frameworks, that fundamentally de-risks these investments. It entirely removes the operational friction that typically paralyzes traditional venture capital.
The definitive conclusion here is that unit-level contribution margins and transaction-level profitability have entirely replaced vanity user metrics. Total registered users, app downloads, honestly, they simply do not matter anymore. The era of subsidized growth is completely dead, and the era of hard, data-driven corporate earnings is absolutely here. If your capital is still chasing consumer app downloads instead of sticky embedded enterprise rails, well, you are structurally misaligned with where the real alpha is being generated today.
Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.